If you have $10,000 gold, $200 silver, what is that, 50 to 1? I mean, so that's very realistic. And I think potentially silver could go higher than that. But right now it's above 41. It does have this psychological, and not just psychological, real resistance at 50, because we have a double top there that goes back to 1980. And then again, we hit it in 2011. So silver has not broken out yet. While gold has, silver is still in this range. So I do expect that it will, there'll be some overhead resistance. But I think once silver is above 50, once we're at 51, 52, and 50 becomes the support, I think it's not going to take long for silver to double to 100.
Peter Schiff of Schiff Gold argues that gold is only beginning its next major cycle, with the real breakout starting in 2024 when the metal finally pushed past $2,000 and steadily advanced toward $3,000 with little notice. He points out that during this climb, many analysts downgraded leading miners such as Newmont and Barrick, assuming the rally had run its course. In Schiff's view, those calls missed the broader shift taking place beneath the surface. He stresses that the underlying driver remains U.S. monetary and fiscal policy, which he describes as increasingly reckless. A weak jobs report highlights just how fragile the labor market has become. Conditions this soft have historically only appeared during periods of severe stress, like the 2008 financial crisis or the 2020 shutdown. Yet, despite this weakness, the Federal Reserve continues to frame the labor market as strong, even as it prepares to cut rates into an environment of rising inflation. Schiff warns that this policy reversal, prioritizing political pressure over price stability, could set the stage for much higher gold prices. At the same time, Schiff points to gold mining stocks as an early signal of where markets are heading. While spot gold traded sideways for months, miners quietly rose 30 to 40%, showing a level of investor confidence that had been missing in earlier rallies. He notes that companies like Newmont have now outperformed even technology leaders in the S&P 500, positioning the mining sector as one of the year's strongest performers, despite still being largely overlooked by mainstream investors. Now, we present the clips from Peter Schiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
Yeah, in fact, I think this cycle really just got started after that consolidation, but I think the leg started in 2024 when we broke above 2,000 and we quietly moved from 2,000 to 3,000 and nobody noticed it. In fact, when gold was hanging out at 2,000, a lot of analysts put sell recommendations on Newmont and Barrick because they thought that gold had topped and they didn't see any upside. And then I think when Trump won, a lot of people expected the gold to fall because the economy was going to boom and Trump was going to do all this great stuff about shrinking the deficit, making America great again. But, now it's becoming more obvious that none of that was true. But I think this is a new leg. We spent really over 10 years. Remember, the first leg of the bull market was 2001 to 2011. Gold went from under 300 to 1,900. So it increased by sixfold, right? Then it really went sideways from 2011 to 2024. Gold traded between 2,000 and maybe 1,500, 1,700. I mean, it initially pulled back to 1,000. It got to 1,050 in 2015. So it held the 1,000, went back up, but only made a new high briefly during the 2020 COVID crisis. It poked its head above 2,000, but then, it got chopped off and it went back down. But that's a huge base that we built around 2,000 as a floor now, because it was resistance. It was the ceiling. Now it's the support. And now we're just starting another leg, which I think will be at least symmetrical to the prior leg. So we had the move from under 300 to 1,900 consolidation. That was a sixfold increase. If you assume we go up sixfold from 2,000, that's $12,000 gold. So I kind of, at a minimum, I think that that's where we're headed. But if we end up having a dollar crisis and a U.S. sovereign debt crisis, we could go a lot higher than that. And I think that there's a good chance that that's going to happen. You asked me what's driving this. It is the monetary and fiscal policy of the United States, which are disasters. And in fact, following the weak jobs report that we got today. And by the way, the jobs market has never been this weak outside of a recession. In fact, the last two times you had a labor market as weak as the one we got right now, it was the Great Recession of 2008, 2009 with the financial crisis, or 2020 as we were shutting the whole economy down because of COVID. So, the Fed has been mischaracterizing this labor market. Powell kept saying we have a really strong labor market. We have a really strong market. He was wrong the entire time. We have a weak labor market. And you would even see how much weaker it was if we had honest statistics. But we don't. But even with the statistics we have, we had outright job decline in June. We lost 13,000 jobs in June. The August number was just plus 22,000. Manufacturing lost 13,000. And the U6 unemployment rate, which is more relevant than the headline rate of 4.3, is 8.1. So we've got rising unemployment and inflation. The Fed said that the labor market was strong, but inflation is weak. They got it backwards. The labor market is weak. Inflation is strong. And I think that's really what's helping to drive the move in gold now and down in the dollar is the Fed is about to start cutting rates into rising inflation. And it's hard to imagine when they've done that before because inflation is above their target and rising, and they're going to cut into that. So it's the opposite of what they should be doing. Even though the economy is weak, inflation is strong. And that should be the primary mandate, is to get inflation back down. But they're going to abdicate that role because of the political pressure to try to artificially stimulate the economy, the housing market. So gold is going to take off from here. We basically just left the launch pad, and we got a long way to go. But, the whole time that gold was going sideways for 3 or 4 months, gold stocks were quietly going up. Gold stocks went up 30-40% while the price of gold traded sideways. And that's something we haven't seen during the entirety of the bull market because the investors in mining stocks have never believed the rally. They've been skeptical the entire time. They're finally starting to accept the fact that gold's not going to crash. But these gold stocks are not priced for current gold prices, let alone the future gold prices. But at least they're pricing out a crash now. People accept, okay, gold's going to be around this level, so we got to bid up these stocks because they're still really cheap, even though they're up better than 90% on the year. And gold mining stocks are the number one performing sector in the market this year, and they're hardly ever discussed. No one talks about them. I think Newmont Mining is the number one performing stock in the S&P 500. The only gold stock in the S&P 500, and it's beating all the tech stocks. Yet probably of all the stocks in the S&P 500, Newmont is probably the one that's the least owned.
Peter Schiff points out that if gold were to advance toward $10,000 and silver toward $200, the gold-to-silver ratio would narrow to roughly 50-1, a level that not only makes sense historically but also highlights silver's potential. While gold has already broken decisively out of its long consolidation range, silver is still confronting a formidable ceiling at $50. That threshold isn't just psychological. It represents a well-established resistance level tested twice before, first during the 1980 surge and again in 2011. The real shift, according to Schiff, comes once silver manages to break through that barrier. If the market moves convincingly past $50 and begins treating it as a floor rather than a ceiling, momentum could change dramatically. At that point, a move to $100 wouldn't necessarily take years to unfold. Instead, the climb could happen quickly, in a matter of months, because once the lid is off, there's little in the way of technical resistance to slow it down. Compounding the potential is the structure of the market itself. Silver has long been heavily shorted, and a breakout would put pressure on those positions. Forced buying to cover losses would add fuel to the rally, amplifying upward momentum. With physical supply already constrained, that scramble for ounces could intensify. In Schiff's view, this dynamic makes silver one of the most tightly coiled opportunities in the market today. Its breakout delayed but not denied. Let's get back to the interview.
I think it's pretty clear if you look at the main buyers of gold the past couple of years, it's been foreign central banks. Why are they doing that? I think they're preparing to replace their dollars with gold. I think gold is going to become the primary reserve asset for central banks. And that's going to be a game changer for the United States because the world is not going to need our dollars anymore. Well, if they don't need our dollars, then how are we going to buy all the stuff that we need because we don't produce it? And how are we going to finance our debt? Because we've been relying on foreigners to finance that debt because they have the savings that we lack. So it's a big problem for the U.S. But I think from a monetary perspective, you're going to see, I think, people utilizing gold using the technology that exists today, whether it's on chain with, tokenized versions of gold, or whether it's just through proprietary closed systems where, the custodian has the gold and just uses technology to allocate ownership digitally so that people can transact business, receive and make payments, send money and receive money using gold, right? Just like using PayPal or Venmo or any other, Zelle or any of these things, you can just use gold. You don't have to transfer your gold. If I wanted to buy something from you and you wanted me to pay you, a gram of gold for it, right? Whatever that is, 30, 40 bucks, whatever, right? I don't have to send you a little bit of gold in an envelope and mail it to you. If the gold is held in a custodian and I have it tokenized in my wallet, I can just email or text you the gram. And now the ownership of the gold goes from me to you. So now you own the gold, not me anymore. You've got it. It's in a vault. Now, if you want the gold, you can have them ship it to you. But why do that? Just hold on to the ownership receipt, because now if you want to buy something, you can pay with gold, because the guy that wants to sell you that, he wants gold too. Why would people prefer gold to dollars? Because gold holds its value. Why would I want dollars when I can have gold? It's like, why use the post office when I can send something by FedEx, right? The free market has provided me with a better alternative than the government, right? Why do people use Uber and Lyft? Because taxis are too expensive. Why are taxis expensive? Because the government provides the licenses and regulates them, and so they're expensive. The free market alternative is, well, I'll just call an Uber, right? So the equivalent of an Uber in the monetary system is gold, right? Gold is the free market's money. Fiat is government money, and it's lousy because it loses its value. The longer you hold it, the less it's worth. The opposite is true of gold. The longer you hold your gold, the more it's worth. So given a choice, especially if you have $10,000 gold, $200 silver, what is that, 50 to 1? That's very realistic. And I think potentially silver could go higher than that. But right now it's above 41. It does have this psychological, and not just psychological, real resistance at 50, because we have a double top there that goes back to 1980. And then again, we hit it in 2011. So silver has not broken out yet. While gold has, silver is still in this range. So I do expect that it will, there'll be some overhead resistance. But I think once silver is above 50, once we're at 51, 52, and 50 becomes the support, I think it's not going to take long for silver to double to 100. I think that move will happen quickly. It may happen in a matter of months, right? Because once we take out that resistance, there's nothing there. And I think there's also a lot of shorts out there in silver that, are going to be in a lot of trouble trying to cover those shorts and buy silver that really doesn't exist. I actually like the fact that this bull market isn't on anybody's radar, because I just assume Wall Street buy into the market later at much higher prices. They don't need to get in now. I want my clients to get in now. And the less competition, the better. I just want to get as much, gold mining stocks and silver mining stocks as I can. And the last thing I want is, Merrill Lynch and Goldman Sachs telling all their clients to buy, right? Because that's going to make it more expensive for my clients. So the longer they ignore this bull market, the better, as far as I'm concerned. Like, I'm in no hurry. I waited plenty of time for this, and I'm in no hurry to speed it up right now. But I do look at that as a positive sign that nobody's invested. The public, has no idea. You have one group of people that are still fixated on Bitcoin, and they're buying Bitcoin instead of gold. Although Bukele, I just read that he just put $50 million into gold, so maybe he's figuring out that Bitcoin is the wrong way to go. But it's interesting that Bitcoin is barely up today, and Bitcoin is more than 15% below its peak priced in gold from 2021. So 4 years, Bitcoin's been losing value relative to gold, despite all the marketing hype surrounding Bitcoin, all the ETFs that were established, the NFTs, the Super Bowl ads, the celebrity endorsements, Donald Trump and the strategic Bitcoin reserve and the Bitcoin czar and making Bitcoin the capital of the world, right? All that pump, and they can't even get Bitcoin to go up. So what does that tell you? But what is going up is the one thing that's not getting any hype, and that's gold. And now silver, going up as well, but not into record territory. So these gold stocks, I think, are still extremely cheap. They could double again from here, and I don't think they'd be expensive, especially considering that if the gold stocks double from here, gold's going to be a lot higher. So it's like they still wouldn't have caught up to where they should be.
It's rare to witness a moment where both gold and silver appear to be standing at the edge of historic turning points. Yet that is exactly the kind of setup the markets now seem to be presenting. Gold has already carved out a clear breakout, building momentum on the back of monetary instability and eroding confidence in policy, while silver lingers just below its long-standing ceiling, waiting for the spark that could send it into an accelerated climb. Mining stocks, once dismissed as relics of past cycles, are quietly signaling that the story is far from over, with performance now rivaling and even outpacing some of the most celebrated sectors of the market. The stage is being set for a shift that could redefine how investors think about both assets and the system they hedge against. The real question is, when this next phase erupts, will investors be prepared to recognize it as the beginning of a new monetary reality, or will they only understand its magnitude once the opportunity has already passed? If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.